Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. And valuation is a very important part of my investment beliefs and philosophies because I do believe that the key to valuation, that if you invest in a stock when you're buying it at its intrinsic value, then that positions yourself as an owner to fully participate in the growth and performance that the business is capable of generating on your behalf. If you pay more than intrinsic value, you will not fully participate in the growth of the business. But if you invest in a company that's growing fast enough, as I'll show you here a little later, you can still make money, but you don't get the full measure of what the company offers. Now, in contrast, if you invest in a company when it's undervalued, you get to participate in the full measure of the company, plus you get some what I call natural leverage, where the stock price will go back to its intrinsic value, which gives you PE ratio expansion, which actually accelerates the rate of return you would get. And the other beauty of buying it when it's undervalued is you get a margin of safety, and a margin of safety is a very important principle of value investing. So with today's video, I'm going to take a look at the home improvement sector, and I'm going to primarily focus on the two big ones, which are Home Depot and Lowe's. But before I do that, let me go ahead and show you what I found when I screened for the home improvement sector. What I came up with were 7 companies. Of course, the big two are Home Depot and Lowe's, but I also found a British company, the ADR, called Kingfisher. I found the towel shop, Grow Generation, which really isn't a home improvement retailer at all. They get involved in essentially home and garden type stuff. And then Floor and Decor, which is a very promising, young, fast-growing company. But the two dominant players are obviously Home Depot and Lowe's. But let's go ahead and look at some of the smaller players. You got Lumber Liquidator here, which has been a good company, primarily works in flooring. And I like to show this because I want you to see how important operating results are to an investor when they invest in the business. Now here you see the stock price starting out at intrinsic value depicted by the orange line on the graph. And in this case, we're looking at a PE ratio of 15 times earnings, which is pretty typical. Then we have the normal PE ratio, which is the valuation the market has most commonly applied. And in this case, we're looking at a PE ratio of 24.5 because you can see the price, the PE ratios have been much higher than the 14 or 15 that we saw down here low. And then you had this acceleration in growth and, of course, this very strong market reaction. And then, oops, once the stock price got ridiculously overvalued with a PE ratio in the 40s, and we ended up with a bad year, a down year in 2014, you could see that the stock price just completely collapsed. And then we got a surge in price for some reason in 2017, perhaps because earnings actually improved quite a bit. They went from a minus $2.51 to only a minus $1.33, but then they went back to a minus $1.90, which is, again, a bigger loss. And, of course, that stimulated another collapse in price. But then we had these 2 really good years, and this is coming in through COVID, where people were staying home and repairing their houses and so on. You had this big run-up. But the point is, you can see how important operating results are to an investor, a long-term buy-and-hold investor, when they're investing in a good business. Towel Shop is a company that basically offers all kinds of different kitchen towels, flooring towel, etc. And you can see that their business has been really degenerating, I guess you would say, since they went public back in 2011. And if I look at long-term performance, you can see it actually has produced a negative rate of return. So the business results are critically important. Now, a very fast-growing, young, as from a standpoint of going public company is Floor and Decor. You can see their IPO came out at about $32 a share with a 61 PE, and it held that for a while. But then, like most IPOs, it eventually reverted to the mean and tracked a 33 PE ratio. And here we're using the PE ratio equal to growth rate. This is a very fast-growing company. Now, what's interesting, even if you had overpaid for it here and held it to here, you would have actually made almost 30% a year. That's the power of growth and compounding. But what's really interesting is, had you been smart enough to buy it when it was trading below its earnings growth rate at a PE of 27 and held it for a shorter period of time, your rate of return would have ballooned up to 65.7% annualized. So you did significantly better. Here you got that natural leverage I talked about in my introductory remarks. Okay, so what the idea here is, we want to invest in a business when it's reasonably valued, so that you can fully participate in the growth of the business. So let's start with the biggest home improvement retailer of all. Let's start with Home Depot here. And let's look at the company from the point of view of its long-term historical earnings growth rate going back to the fiscal year end 2000 into 2001. And this company has a January fiscal year. This was the irrational exuberant period, if you recall. The PE was extremely high, and that led to very poor performance on Home Depot over the next couple of years. You would have seen, roughly a 63% total drop in the value of your investment. In other words, you put $10,000 in, it would have only been worth $3,697, and that includes dividends, which it started paying actually in 2002. But I also want you to notice that then the stocks tracked its earnings line very beautifully all the way through 2011, but we also had some down years here. And so when the earnings were doing well, the price did well. Then when the earnings collapsed, the price collapsed. But then what I really want you to note here is note the acceleration in growth coming out of the Great Recession. So I'm going to shorten this to a 13-year time frame. What I want you to see now is that Home Depot's growth has accelerated over this time frame to over 18%. So for a very fast-growing company like this, I'm using the P equals growth rate, or the fast graph tool automatically calculates the P equals growth rate of 18.35. So the orange line is a PE of 18.4 rounded, and then the blue line is the normal market value. You can see there's a bit of a separation here, but this gives you a range of valuation. The blue line is 20.7, or a PE of 20, we'll call it just approaching 21. And then as you look at this, I want you to make sure that you're analyzing what you're looking at here. There were times back in 2010 and 9 where you could have bought the company at a 14 or 15 PE. There were some times here in 2015 and 16 where the PE got up to 23, and then currently the PE is at 24. But I do want you to note, even had you paid a PE of 25 on November of 2015 and held it to fair value, not to what its current price is, but held it to fair value, and I'll pick fair value here for the beginning of 2021, you can see that you would have still made 12% a year had the stock traded at fair value. But because the stock is trading at a slight premium valuation right now, you'd have made almost 18%. So the point is, you can overpay for a great growth stock like Home Depot and still make good money. But the real point is, had you bought the stock, when it was reasonably priced back here at around 18 PE like the growth rate was, and held it to here, your rate of return balloons up to 24%. So once again, you get the full measure of the business plus the PE ratio expansion. But nevertheless, Home Depot is now pretty fully valued, I would call it, to not moderately overvalued. But again, not crazy. You could have bought it at a high PE like this, before, as I pointed out, and still made money. But if I'm looking at forecasting here, this is the key. I can't buy that history. I got to buy the future. Expectations are for 10% growth over the next couple of years. That would indicate a fair value of a PE of about 15 because it's below 15% growth. So that means you could see losses here. Now, if Home Depot traded at its normal 22 multiple, and despite the fact that its growth rate was slowing, you could make modest rates of return here, but they would still be very modest relative to the amount of risk you're taking. I think that's very important to understand. Now, if I keep this 22-ish PE in mind and look at the long-term growth rate, the company is expected to grow at 11.7%. So if I priced it at that 22 PE, I could make double-digit rates of return if the market would continue to give it that valuation. If the market gave it a 15 PE valuation, you'd be looking at less than 5% annualized rate of return. And of course, you could run these different PE ratios and see different values. The point is, you're taking a lot of risk in buying the stock right now and not really necessarily going to get a very high rate of return if everything goes as the world expects on Home Depot. Now, this is a $328 billion market cap company. It's A-rated. That has 91% long-term debt to capital. But I'll get into looking at their cash flows a little bit later in the video. But anyway, that's Home Depot. In contrast, we have the second giant here, which is a $129 billion market cap, which is Lowe's. Now, you see almost a similar picture. The difference here is that Lowe's traded pretty much, just moderately overvalued back during the irrational exuberant period compared to Home Depot. but it did track earnings, and I'm using a PE of 15.32 because that's the growth rate. Once the growth rate's over 15%, but again, it's more or less a 15 PE, and the normal multiple here is around 20, the blue line, and you can see the stock pretty much stayed within those valuation ranges, occasionally getting below the orange line, occasionally getting above the blue line, but it tracked this very nicely. Now, if I look at long-term performance for this 15% grower, I get just about a 15% annualized rate of return, plus dividend income does get me up to a 15.3% rate of return, which is significantly better, almost double the rate of return. But obviously, because of the power of compounding, $10,000 would have grown to $183,858 growth plus dividends versus only $41,769 in one of the better stock markets we've had over this long-term time frame, notwithstanding the Great Recession that we went through. So, Lowe's has been a superb company, but if I go back to that shorter time frame post the Great Recession, now we get a different picture of Lowe's. And this is what I really want to focus on here with this video. Now we have a 19.26% growth rate. So the orange line has shifted to a fair value of 19, and you can see that Lowe's really followed that 19-ish multiple up to 20 multiple very, very consistently since, the beginning of fiscal year 2011, which ends again in January 2011. So here we've got a 19% growth rate, and this is what I mean about getting the full measure of the company. If I look at performance here, I get a 21% growth, annualized growth. Add in dividends, I get 21.7. I got less, dividends here than we saw with Home Depot, but I got a nice dividend record. And the point is, I've got just a little tiny bit of overvaluation. The blended PE's 19.96, but I'm essentially fully participating in the 19% growth on the capital appreciation, if you will, that the company generated on my behalf. Now, we can't buy the past, as I said. We can only buy the future. So when I look at forecasting, here I see a little bit better expectation, which makes some sense for this $134 billion company, which, by the way, is triple B plus, just one notch below Home Depot, but it has almost the exact same amount of debt of Home Depot. It does offer me a dividend yield of 1.69% and an earnings yield of only 5%, which is below the 6.5% to 7% I like. But when you get faster growing businesses, you can accept a little bit lower level of current earnings yield for the higher earnings yield that the company is going to produce due to the law of compounding. So here, even at a 15 PE, this gets us to a 6.37% annualized rate of return. If we get that 19 to 20-ish PE, 19.95 here, we'll call it 20, now we've got a stock that can give us double-digit rates of return over the next several years. And the longer-term growth rate in this case is expected to be 16%, which again, at a 16 PE would give us 12.78%. At that closer to 20 PE that we talked, which has been normal for the company, we'd be looking at 17.85%. So bottom line here is, if I was going to invest in the home improvement sector today, Lowe's makes quite a bit of sense. But let's look at it also from the standpoint of debt and cash flow. Let's look at both Home Depot and let's look at Lowe's. Let's start with Home Depot. What I want to do here, I'm going to use the new version of Fast Graphs because it's so much faster. We hope to be launching this in the next 3 to 4 weeks, by the way. We're beta testing it right now internally and have all of our developers running lots of tests. But anyway, operating cash flow wise, this is critically important. You can see that, Home Depot did track its operating cash flow very closely. When it got, too high, it reverted to the mean, which like it is right now. So that could mean we could see a reversion to the mean, if you will, on operating cash flow. But the thing I really like about operating cash flow when I'm looking at a dividend paying stock is A, that they're covering their dividend, which is the white line on the graph here, extremely well. Also, it tells me they have, a very good opportunity to amortize their debt. The company, most of their debt's long-term, and they've got the cash flows to support it. Now, I can also go in a little deeper and look at free cash flow, which is what's left over after what they spent to run the business. And I get a very similar picture here from the point of view of I've got very strong dividend coverage. And again, another indication that the company will have no trouble amortizing its debt. And it's actually earning quite a good return on the debt that it's borrowed here. Ebitda is another good valuation indicator. And again, Home Depot looks moderately overpriced based on Ebitda. And then finally, I'm going to look at price to sales here. And you can see that the stock has traded at, as low as 0.8, 0.9 price to sales. More recently, it's been trading at 1.5 to 2, and it's right now at 2.44 times sales. The blended price to sales ratio is 2.44. I think that's a little high. So Home Depot looks to me like it's a great business, but it's moderately overvalued based on all these metrics. Now, if I move on to Lowe's and look at Lowe's here, in contrast, if I look at it from a standpoint of operating cash flow, it's actually undervalued based on the way that it's tracked its operating cash flow. Operating cash flow is significantly covering the dividend, which again is something I really, really like when I'm looking at a dividend paying stock. When I go to free cash flow, I see the same picture. I've got free cash flow covering the dividend at a very strong, very high rate in all these recent years here. And then if I go on to Ebitda, which I like to use as a valuation reference, I'll go ahead and max them out here. The stock is trading at a reasonable level of Ebitda. But considering that Ebitda is expected to grow pretty strongly, this would, indicate some nice rates of return going out here over the next couple of years of at least 6.5 to 7%, which I consider to be a conservative projection. And then finally, if I look at price to sales, just like we saw with Home Depot, Lowe's is trading at a little higher price to sales than historically normal. So that simply tells me, although this stock is reasonably valued today, and if I go back and look at adjusted operating earnings and look at it from a shorter time frame here, it's only moderately overvalued. I would love to be buying it when it had a margin of safety, like you could have done at the beginning of COVID when we had the flash crash of COVID. It's always better to buy these stocks when you can get them with a margin of safety. But this would still be, in this very inflated market, a decent investment, if you will, considering the fact that it is expected to grow so much faster than Home Depot, I think mostly because of its size, but also because of some of the initiatives the company has achieved. Anyway, this has been the home improvement sector. This is Chuck Carnevale saying thanks for watching. If you like the video, please give me a like, ring the bell, subscribe to the channel as well, because I'd love to have you have access to the future videos that I'll be posting on a regular basis. Thanks for watching. We'll talk to you again real soon.